Hello viewers, welcome to my channel. I am Hasham. Last video I have explained you the meaning of the term financial management. The subject is financial management for BBA. So in the previous video I have explained the meaning, definition, scope and objectives of financial management. In unit number 1 you will have completely theory, introduction to financial management. In examination you may get a theory question on this unit. So be perfect about the concept, then only we can go for problems in financial management. The last video I have explained you about the objectives of financial management. So broadly we have classified the objectives into 3 types. That is profit maximization, wealth maximization and value maximization. The last video I have explained about the profit maximization and wealth maximization. Now in this video, the remaining part, theoretical part I am going to explain. And this will be the end of this unit number 1. So before starting the explanation of value maximization, take the screenshot of the points which I have written on the board, then I'll explain every point in detail. Now, value maximization. This is also one of the objectives of financial management. There are drawbacks of keeping profit maximization or wealth maximization as an objective. So many practitioners, they have suggested this wealth value maximization should be the ultimate objective of financial management. So what does it mean? So value maximization as a goal of financial management is similar to wealth maximization goal, but the focus on not only on shareholders, but there are many stakeholders. That means one of the main stakeholder is shareholder, but the business should not function only for the sake of shareholders. Apart from shareholders, there are many stakeholders of the business like supplier of funds, supplier of material, employees, consumers, government. So all these are the stakeholders. They are also having the interest in the business. The financial management should keep the objective of satisfying the needs of all the stakeholders, not only shareholders. That means the scope of this objective is very much large compared to the scope of objective profit maximization or wealth maximization. Not only of the shareholders but also other stakeholders of the firm, including customers. The customers are also one of the stakeholders because they are interested in buying reasonable value goods. That means the goods should be of better quality at a reasonable price. These are the interest of customers. Then apart from that, employees. The employees are also stakeholders because they are giving their time, their effort, their knowledge. So they have to be paid. So fair remuneration should be given, promotion opportunities should be given, incentives should be given. That means the employees should be satisfied. Then supplier. The supplier have supplied the funds as well as material. So they should be paid on time. Apart from that, communities and society at large. These are all the stakeholders. That means the objective of the financial management should be to satisfy all the stakeholders. This approach recognizes that businesses operate within a broader societal context and should create value to all stakeholders, not just shareholders. That means the business is a part of the society. So many parties are having stake in the business, and it is the responsibility of the business. It is the responsibility of the finance manager to take into consideration the interest of all the stakeholders apart from shareholders. Now therefore it adopts a holistic approach focusing on overall value of the firm. So comparatively, this is a holistic approach that means giving the value to all the stakeholders. Increase in value in the firm benefits all the stakeholders. When the business operates, when the finance manager takes financial decisions, it should benefit in creating the value to all the stakeholders. Now the objective emphasizes on factors such as corporate social responsibility. This factor was not considered in profit maximization objective, in wealth maximization objective, but in value maximization, corporate social responsibility. That means what is the social responsibility of the company towards the society? That should also be considered. And ethical practices. The business should adopt some ethical practices. Should not do anything which is unethical to the society, unethical to different stakeholders. It should follow ethical practices. Environmental sustainability. That means the environment should be protected in the long-term basis and long-term relationship with all the stakeholders. These are the factors which should be focused by the finance manager, and this objective is called value objective. Therefore, value maximization is comprehensive approach. It's a very wide approach, and financial management that emphasizes not only on long-term sustainability of the firm but also focus on social and ethical considerations. That means keeping value maximization as an objective, we must consider the society, we must consider the ethics of the business. So it's a very comprehensive objective. Now, in summary, while profit maximization focuses only on short-term profitability, very narrow objective of financial management is profit maximization. It is concentrating only on creating the profit, generating the profit in the short period of time. Whereas wealth maximization considers the value creation to the shareholders. That means wealth maximization as an objective is focusing only on increasing the value or wealth of the shareholders. Remember, shareholder is only one of the stakeholder. Whereas value maximization takes a broader view and aiming to create value to all stakeholders in the business. That means this value maximization has a wider scope. It has to create the value of all the stakeholders of the business. So this is the end of the topic, objectives of financial management. All the three objectives I have explained: profit maximization, wealth maximization, and lastly value maximization. And this question is frequently asked in examination: explain the objectives of financial management. So watch the video 2-3 times. Definitely you will get all the points. You can write these points in examination. Now, other objectives apart from this profit maximization, wealth, or some other objectives of finance manager. The objectives are timely supply of finance to all the departments. Every department of the business require funds. The timely supply of funds to all the departments, that is also one of the objectives. Secondly, effective utilization of finance. There should not be any shortage of finance nor surplus of finance. That means if there is a shortage of finance, we cannot be able to function. If there is surplus of finance, the excess of finance will decrease the profitability. Idle funds will not generate any income, but it will incur cost. So effectively utilize the funds and adjusting the risk. That means in the short period of time, that means when we keep profit maximization, we ignore the risk factor. But always there is a relationship between risk and return. Higher the risk, higher the return. So it is the responsibility of the finance manager to adjust, to manage, to control the risk. Next is growth of the enterprise. The objective is to grow the enterprise, to grow the business. So it is the objective of the finance manager to have the growth of the enterprise. Next one, timely payment of wages to the employees, fair settlement with the supplier. That means good relationship should be maintained with the supplier. Timely payment of interest charges to the lenders. Timely payment of taxes. We should obey the law. That means timely the business should pay the taxes. Payment of reasonable dividend to the shareholders. And lastly, maintaining relationship with financiers. So these are all the other objectives of the financial management. Now, role of finance manager. What the role finance manager plays in a business organization? First one, financial planning and control. Finance is also one of the resource apart from land, building, furniture or machinery, human resource. All these are the other resources. Among the resources, finance is very important. The financial planning and controlling, that is the role of finance manager. That is the role the finance manager has to play. Secondly, raising of funds. Whenever funds are required, the finance manager responsibility is to procure the funds, raise the funds from different sources, providing information. Today, lot of information is required because innovation is taking place. Lot of changes are taking place in the market. That means getting and collecting the information. Working capital management. These are the short-term funds required for meeting day-to-day expenses to maintain the liquidity of the business. So it is the role of the finance manager to maintain liquidity. Working capital management. Efficient utilization of funds. Funds should not remain idle. That means all the resources, all the funds should be properly deployed. Next, understanding the capital market. It is the role of the finance manager to have a complete information about the capital market. It will have an impact on the business. Dividend declaration. The finance manager has to help the management in declaring proper dividend. That means the dividend policy will have an impact on the growth of the business, on the survival of the business. Next, data science analytics. Lot of innovations are taking place. So the finance manager has to collect the data, has to make the data analytics, and apart from that, compliance. Nowadays, lot of laws are there. Companies Act, Income Tax, GST, SEBI, so many laws are there. So the finance manager has to comply the law. Next one, innovation. Many innovations are taking place in the financial market. New instruments are taking place. So the finance manager has to be acquainted with the innovations taking place in the financial markets. Treasury management, that means the funds. The funds management. Last one is negotiation. A large part of the finance manager is invested in making negotiation with the supplier of funds. So this shows the role of the finance manager. Now, approaches to financial management. Previously, in examination, a theory question was asked, explain the approaches of the financial management. Scope of financial management has gone a number of changes over a period of time. Earlier or traditionally, the scope of financial management was very limited. But nowadays, because a lot of development taking place, technological development, marketing development, so many developments are taking place. So the scope of financial management has also changed. Until middle of the century, its scope was limited to procurement of funds. In the middle of the century, that means in the beginning, traditionally, the scope was limited. The financial management scope was only procurement of funds. In modern times, financial management includes, beside procurement of funds, the three different kinds of decisions. Apart from procurement of funds, three types of decisions the management has to take, the financial management has to take. And the three different kinds of decisions, such as investment decisions, financing decisions, and dividend decisions. So first of all, traditional approach. Traditionally, what the finance manager used to do, what are the activities finance manager will have performed in the past. So under the traditional approach, the role of financial management is limited to raising and administering of funds. It broadly covered the following aspects: only raising the funds and utilizing the funds. These are the only two things which are there in the functions of financial manager traditionally. So what are the aspects? First one, estimating the requirement of funds. Before raising the funds, the finance manager has to estimate how much funds we require. So that is the first function. Secondly, raising the required funds. Once the funds have been estimated, secondly, the raising of funds, from where to procure the funds. Thirdly, preparation of financial reports. And lastly, managing the cash level to meet the day-to-day obligations. So these are the only aspects in the traditional approach to financial management. Now the modern approach. So presently, what are the aspects of financial management? The technological improvement. If we compare the traditional situation and the present situation, what we see, lot of technological improvement was there. Innovative marketing operations. The marketing operations have entirely changed. The business complexion have changed. Development of strong corporate culture. Earlier the business was a different types like sole trading or partnership, but nowadays corporate culture has evolved. And keen business competition. Lastly, presently a lot of competition is there. Internal competition, external competition, the global markets have been found. So all made it imperative for the financial management to make optimum use of financial resources. On account of all these changes, it has become imperative for the financial management to make the changes in the financial decisions. Now the modern approach to finance function was started during 1950s, in the middle of the century. Its scope is wider since it covers conceptual and analytical framework for financial decision making. Conceptual and analytical framework, the method have been completely changed. In other words, it covers both procurement of funds as well as efficient allocation among the various investments, which will help to maximize shareholders' wealth. So ultimately, we have to maximize the wealth of the shareholders. Now, therefore, as per the modern approach, the financial management concerned with three important decisions. The three important decisions are investment decisions. So, before making investment in a project, the finance manager has to evaluate what would be the consequences of making or investing in the capital project, for which different techniques are available, like capital budgeting decisions for long-term investment proposals, and for short-term investment proposals like working capital management, we have receivables management techniques, cash management techniques, inventory management techniques. All these are the investment decisions the finance manager has to take. Secondly, financing decisions. Financing decisions are concerned with procurement. We need the funds for short-term basis as well as long-term basis. So from where to procure the short-term funds? Where to procure the long-term funds? For long-term funds also, a business can procure from equity shares or preference shares or debentures, like that. So these type of decisions are called financing decisions. Lastly, dividend decisions. Dividend is the part of the profit which is distributed by a company to the shareholders. The dividend will be distributed from the profit, but no company will distribute all the profits among the shareholders in the form of dividend. Some profit is retained and the part of the profit will be distributed. So how much to retain and how much to distribute, that is called dividend decision. And dividend decision will have an impact on the performance of the business, on the growth of the business. So here the finance manager has to help the management in taking the decision, in taking dividend decision, how much to be distributed and how much to be retained. So this is the end of the first chapter. In this first unit, we have learned about the meaning, definition of financial management, what is the relationship of financial management with other departments, what is the scope of financial management, what are the objectives of financial management, what are the approaches of financial management, and what is the role of finance manager. These are the things, if you watch this video 2-3 times, definitely easily you can write the theory question in unit number 1. The second unit is regarding time value of money and capital budgeting decisions. Inshallah, we'll take up the next unit in the next video. So give a like to the video, share